37.6 million ounces vanished in 47 days. That's the number nobody can explain. That's the number that changes everything. From COMEX vaults, from the exchange that supposedly backs the entire silver futures market with physical metal. 37 million ounces in 47 days. October 1st to November 15th, 2024. 1 million ounces per day in some cases. And after that drain, after that rapid descent, from 100 million ounces down to 43 million ounces, the market woke up. The lease rates spiked to 39%. The spot price went into backwardation. And right now, in December 2025, we're sitting at the threshold of something most people don't understand but should. We're sitting at stage 3 of a 4-stage squeeze, a pattern that's repeated throughout history whenever a critical resource becomes scarce enough that the system breaks. And today, I'm going to walk you through exactly what stage 3 is, why the math proves it's happening right now, and what comes next. Before we understand stage 3, you need to understand why this matters. The COMEX is not just some random exchange. The COMEX is the discovery mechanism for silver prices globally. More contracts trade on COMEX every single day than actual silver exists in the vault. Let me repeat that. More paper silver trades daily than physical silver sits in that vault. This creates a system that works perfectly as long as physical inventory is abundant enough to absorb delivery demands. But when physical inventory drops below critical levels, the paper market becomes vulnerable. The structure cracks. And that's exactly what's happening right now. Let me walk you through the timeline because the timeline is everything. In March of 2020, registered COMEX silver inventory stood at 346 million ounces. That's the peak. That's the maximum the vault held in recent history. From there, the decline began. Year after year, month after month, the inventory fell. By December 2023, it was down to 82 million ounces, 76% decline in just 3 years. But that was just the warning. That was the slow burn. Then, October 2024 arrived. COMEX registered stood at 100 million ounces. It looked stable. It looked like maybe the decline had stabilized. It hadn't. What happened next was the shock. Between October 1st and November 15th, 37.6 million ounces disappeared. In 47 days, not in a month, in 47 days, that's 800,000 ounces per day on average, peaks of 1 million per day. The vault was draining at a rate never seen before. By November 15th, the inventory was down to 63 million ounces. That's a 43% decline in under 2 months. And the decline continued. By December 2025, right now, registered inventory sits at just 43 million ounces. 303 million ounces gone in 5 years and 9 months. That's 53 million ounces per year average. But accelerating. The recent acceleration was violent, and here's what matters. 43 million ounces equals 18 days of global silver consumption. 18 days. If the world stops producing silver tomorrow, if no new ounces enter the system, COMEX runs dry in 18 days. Not 18 months, not 18 years, 18 days. So where did it all go? That's the question everyone asks. Industrial users started hoarding when the shortage signals became undeniable. Solar manufacturers started securing supply. EV makers started building reserves. They know what's coming. They know supply is tight. They're locking in inventory. Silver ETFs had inflows of 95 million ounces in just the first half of 2025. Not selling, buying, massive institutional money flowing in. JP Morgan alone holds 169 million ounces in COMEX vaults. That's 40% of the registered inventory. One bank. 40% of the exchange's deliverable silver, and JP Morgan has been accumulating since 2011. Analysts estimate their total holdings at 675 million ounces. That would represent roughly 45% of the world's above-ground supply in 1,000-ounce bars. This wasn't random. This was strategic. And some of the inventory went to private vaults, people and institutions who want physical metal outside the banking system, outside the exchange, in their direct control. This is the shift that defines stage 3, the recognition that paper silver is increasingly risky, that physical metal is the only protection, that if you don't hold it, you don't own it. And that belief is driving the drain, accelerating it, creating a feedback loop where lower inventory drives higher demand for physical, which drains inventory further, which increases the perception of scarcity, which drives even more demand. This is mechanical. This is inevitable. This is stage 3. But let me be precise about what stage 3 is. Stage 1 is abundance. Supply exceeds demand. Inventories build. Prices are low. Nobody worries. Stage 2 is the beginning of pressure. Demand starts exceeding production. Inventories decline. Prices rise modestly, but confidence remains. People still think there's plenty. Stage 3 is where we are right now. Demand has clearly exceeded production. Inventories are collapsing. Prices are rising sharply. Physical becomes harder to get. Lease rates spike. Backwardation appears. And the market begins to understand that the system has changed, that scarcity is real, that some people will get metal and some people won't, that allocation is coming, that rationing is beginning. The evidence of stage 3 is everywhere. The lease rate signal is the clearest. These are interest rates for borrowing physical silver. Normal lease rates are less than 1%, sometimes 0.1%. Borrowing silver is cheap when there's plenty. But in October 2025, the 1-month lease rate spiked to 39% annualized. 6,500% increase in 3 months. What does that mean? It means traders were so desperate for physical silver, so desperate to cover short positions, so afraid of delivery failures, that they'd pay 39% just to borrow metal for 1 month. This doesn't happen by accident. This happens when the physical market understands it's stressed, when traders know something is wrong, when they're willing to pay extreme cost to borrow rather than accept the risk of default. And this signal has historical precedent. In 1980, before silver crashed, lease rates spiked. In 2011, before silver rallied, lease rates spiked. Lease rate spikes are the early warning system. They precede major moves. They signal that the physical market is in distress. Backwardation appeared in October. This is the technical signal that really matters. Normally, futures contracts that expire further out trade at higher prices than nearby contracts. Why? Storage costs. If you buy December silver at $58, March silver should be $59 or $60 because you pay for storage between December and March. That's contango. That's normal. That's healthy. That means there's plenty of supply. The market is comfortable holding inventory forward in time. But backwardation is the opposite. Backwardation is when nearby contracts trade at higher prices than future contracts. It's when people pay more to get silver today than to get silver 3 months from now. From a standard finance perspective, this is insane. Why would you pay more for something today than tomorrow? You wouldn't, unless you believed tomorrow might not have enough. Unless you believed supply was uncertain. Unless you believed the future was different from the present in a way that makes today more valuable. In October 2025, spot silver traded $2.88 above futures. That's unprecedented. That's a market screaming that metal is tight. Tight right now. The backwardation lasted into November. The signal persisted. Traders continued voting with their orders that today was more valuable than tomorrow. This is stage 3 behavior, and it has historical precedent. In 1980, backwardation appeared before silver spiked. In 2011, backwardation appeared before silver rallied. Backwardation is the market's way of saying that something in the structure has changed. Supply is no longer sufficient to meet demand at current prices. Something must give. Either price must rise dramatically to destroy demand, or supply must somehow increase, or both must happen. But something must change, and the industrial demand context explains why the change must happen. Solar demand for silver went from 60 million ounces in 2015 to 232 million ounces in 2024. That's 387% growth in 9 years. It's not slowing. The International Energy Agency projects 250 million ounces annually by 2030. Solar is accelerating. Government mandates ensure that. Renewable energy targets won't be relaxed because silver is expensive. They're fixed. The demand is structural, policy-driven. Electric vehicles consume nearly triple the silver of traditional cars. EV adoption is accelerating globally. Government mandates ensure that too. Regulations require EV transition. Demand for silver in vehicles will grow, and it's not price sensitive in the near term. You can't just switch to a traditional car because silver is expensive. The regulation already made that decision for you. The demand is structural. Data centers and AI infrastructure require exceptional electrical conductivity. They're choosing silver for precision applications. Data center electricity demand is growing 21 to 33% annually. This is the fastest growing demand segment in the entire silver market. It's just beginning. It's not mature, it's accelerating. And the demand comes from government and institutional investment in AI infrastructure, not from price-conscious consumers. The demand is structural. The total industrial demand is 680 million ounces annually. Mining produces 843 million ounces annually. But that assumes all mining production reaches market. It doesn't. 70% is byproduct. It comes from mining copper and zinc and lead. If those metals aren't profitable, mining stops. If copper prices crash, zinc prices crash, the mines close, silver production stops, just stops. You cannot increase silver production independently. You cannot say we need more silver, so let's mine it. It doesn't work. The mines are profitable or they're closed based on the host metals, not on silver. And because silver production peaked in 2015 at 887 million ounces and has been flat or declining since, the system cannot increase supply quickly enough to meet growing demand. The deficit is now structural. In 2021, 50 million ounces short. 2022, 70 million ounces short. 2023, 85 million ounces short. 2024, 148.9 million ounces short. That's a record. 2025 is projected at 207 million ounces short. Cumulative 5-year deficit of 661 million ounces. That's 661 million ounces drawn from above ground inventories in 5 years. Inventory that accumulated over decades, disappearing in years. At current rates, at current demand, the strategic supply is being consumed in 15 to 20 years. But at accelerating rates, the timeline compresses. This is the math of stage 3. This is why the COMEX drain is mechanical. This is why inventory is dropping faster, not slower. This is why the lease rates spiked. This is why backwardation appeared. The system is running out of a critical resource, not in a distant theoretical future, right now, in front of us, in December 2025. And stage 4 is coming. That's the critical question. What does stage 4 look like? We have historical precedent. In 1980, the Hunt brothers tried to corner the silver market. They accumulated 200 million ounces. They demanded physical delivery. COMEX panicked. They changed the rules. Silver Rule 7, no new long positions. Leverage requirements skyrocketed overnight. The Hunt brothers were forced to liquidate. Prices crashed 78% in a single day. March 27, 1980, Silver Thursday. The market was reset. The system was saved, but through force, through rule changes, through changing the rules mid-game when the crisis became too severe. In 2011, Stage 4 looked different. Silver rallied from $32 to $49 in 4 months. The rally was strong, but not violent. COMEX didn't change rules. The market adjusted. Prices climbed. As prices climbed, demand moderated. Substitute materials were explored, and the market found equilibrium over time. Different outcome. Same 4-stage pattern. The question is, which path silver takes in 2025? Will Stage 4 look like 1980? Rules change. Margin requirements skyrocket. The market crashes 75 to 80% in a short period. Leverage is forced out. The system resets. Or will Stage 4 look like 2011? Prices climb steadily. Demand moderates. The market adjusts. Equilibrium is found. Or is there a third path entirely? Because the situation now is different from 1980 and 2011 combined. In 1980, it was 2 billionaires and their leverage. Kill the position, and the problem goes away. In 2011, it was broad investment demand plus industrial demand. Still manageable. But in 2025, the shortage is structural. It's not leverage. It's not speculative demand. It's 5 years of consecutive supply deficits. It's policy-mandated industrial demand that cannot be destroyed by high prices. Silver must be used. Governments have committed to solar deployment. Governments have committed to EV adoption. Governments have committed to digital infrastructure. These aren't market-driven demands that can be killed by price. These are policy-driven demands that must be met regardless of cost. This changes everything. This means Stage 4 cannot simply be a leverage crash that resets prices. Because leverage isn't the problem, the shortage is the problem. And shortages don't disappear because you change margin rules. They persist until supply catches up or demand is destroyed. And demand won't be destroyed. New mining takes 8 to 15 years. So the math says Stage 4 is inevitable. The price is inadequate. The price of silver at $59 is not high enough to balance supply and demand. Higher price is required. Much higher price. How much higher? That depends on speed of supply response. If new mining comes online faster than expected, if recycling increases dramatically, if substitution happens, if demand destruction occurs, then maybe $59 is close to equilibrium, maybe prices don't spike much higher. But if supply response is slow, if mining continues declining, if recycling can't scale, if substitution fails, then prices must continue rising. The math is mechanical. Production is 843 million ounces. Consumption is 680 million ounces. The shortage is 163 million ounces annually. The price must rise until one of 3 things happens. First, production increases, takes 8 to 15 years. Second, demand decreases, either through price-destroying consumption or through recession-destroying economic activity. Third, above-ground inventory is fully consumed and the system resets. Most likely scenario, all 3 happen slowly over time. But the transition won't be smooth, it will be volatile, it will overshoot. Prices will spike higher than long-term equilibrium. This is Stage 4. This is what comes after Stage 3. And here's what's important about understanding Stage 4. The people who see it coming prepare before it arrives. JP Morgan accumulated 675 million ounces, not because they're gambling, because they see the math. Governments are quietly accumulating, not because they're speculating, because they see the structural shortage coming. Institutional smart money is moving from paper to physical, not because it's emotional, because it's logical. The physical market is where the real value is. Paper silver is increasingly risky as the system tightens. The retail investor, who understands Stage 3 and Stage 4, has time to act, right now. In December 2025, before the freeze, before dealer premiums spike 50%, before waitlists extend months, before access becomes impossible, the window is open. It's not wide open. It's closing, but it's open. The evidence is clear. COMEX inventory is 18 days of consumption. Lease rates are spiked at 39%. Backwardation is here. Mining cannot respond quickly. Industrial demand is policy-driven and structural. 5 consecutive years of deficits prove the trend. JP Morgan's accumulation proves institutional awareness. Government hoarding proves sovereign concern. The math proves Stage 3 is real. Stage 4 is coming. And when Stage 4 arrives, the people positioned will be the smart ones. The people who bought physical silver before the dealer freeze. The people who understood the pattern. The people who acted when action was possible. They'll own metal. They'll be protected. Everyone else will be on waiting lists. Hoping, competing, locked out. So what happens now? You understand Stage 3. You understand the math. You understand that Stage 4 is coming. You understand that supply and demand must rebalance, either through price rising dramatically or through rule changes forcing reset. Either way, the current price is inadequate. Higher price is necessary. The bull case is straightforward. Prices rise to $100 to $150 per ounce by 2027. Supply deficit persists. Mining doesn't ramp fast enough. Industrial demand continues. ETF inflows continue. Institutional smart money continues positioning. The shortage becomes acute. Price spikes to equilibrate. This scenario is supported by historical precedent, by fundamental analysis, by supply constraints that cannot be overcome quickly. The base case is also clear. Silver consolidates between $60 and $85 per ounce through 2026 and 2027. High volatility, but no explosive move higher. Supply and demand gradually rebalance. Recycling increases. New mining comes online by 2027. Demand moderates from current levels. Lease rates normalize. The acute phase ends. The market adjusts through normal price mechanisms. This scenario mirrors 2011. It's the most likely outcome. Markets adjust. Prices reflect supply and demand over time. Equilibrium is found. The bear case exists too. Silver corrects to $40 to $55. COMEX implements rules like Silver Rule 7. Margin requirements skyrocket. Leverage is forced out. Economic slowdown reduces industrial demand. Supply surge from delayed mining online. Demand destruction from lower prices. This scenario mirrors 1980. It's possible. It requires a trigger, but mathematically it's possible. Most likely, the base case. The market adjusts over time. Prices remain elevated relative to historical norms. COMEX inventory stays at 40 to 60 million ounces. Lease rates remain elevated at 5 to 20%. The acute phase lasts 2 to 3 years. Then gradually, supply and demand balance. The crisis phase ends. New normal is silver at $60 to $80 per ounce. But all scenarios require one thing: higher price than today. All scenarios, all outcomes, all mathematical paths lead to a conclusion. Silver at $59 is inadequate. The price is wrong. The price will rise. The math demands it. Supply is 163 million ounces short annually. That doesn't balance at current price. It balances at higher price, higher demand destruction, higher supply, or both. So stage 3 is real. Stage 4 is coming. The window to understand this and position is closing. Right now is the moment. Not tomorrow, not in 6 months. Right now. The pattern is clear. The math is mechanical. The history is precedent. Stage 3 precedes stage 4. Always. The COMEX drain is stage 3. The lease rate spike is stage 3. The backwardation is stage 3. And stage 4 follows. Inevitably, without exception. The question is whether you understand it, whether you prepare for it, whether you position before it arrives. That's the difference between being ahead and being left behind.